I'm going to bet you that when the S&P does start down again and prove gold will be advancing through the 3,500 and all the way up. And look at silver since mid-April. It's gone up. So this fits with another scenario we have, and that is the asset flows in that area now favor the miners in silver. And therefore, we do think silver will see that zone. And when I say 60 to 70, all I mean is we're going to just blow out those silly old highs, because they really are silly. Because given the monetary degradation since 2011 or 1980, silver would probably be $200 to match the real buying power of silver at those peaks. And ultimately, that's probably where it's going.
Silver is quietly building toward a breakout that could shock even seasoned investors. For years, the metal has lagged behind gold, failing to reclaim its 2011 highs near $50 an ounce. But market dynamics are shifting. The supply-demand balance has been tight for years, with no excess production to meet the growing demand. Now, a new demand driver, the solar industry, is accelerating the trend. China alone produces roughly 80% of the world's solar panels, each of which requires significant amounts of silver. At the same time, the monetary backdrop remains the ultimate catalyst. Over the decades, fiat currencies have been relentlessly devalued. The M2 money supply chart is practically vertical, showing explosive growth since the 1960s. In real terms, a loaf of bread that cost 20 cents decades ago now costs dollars, and the same applies to every major asset. Gold has historically tracked this degradation, and silver, though prone to periods of underperformance, has always caught up in sudden, explosive moves. MichaelOliver, a respected momentum analyst with a track record of calling major market shifts, sees silver preparing for another such move. He points out that in past cycles, silver has surged far beyond expectations once it breaks above long-standing resistance. The old highs of $50 set in 1980 and 2011 are no longer meaningful in absolute dollar terms. Adjusted for monetary degradation, those peaks would equate to $200 today. This is why breaking $50 won't just be symbolic. It could unleash a buying frenzy. Investor psychology plays a critical role here. Once silver convincingly takes out that long-watched level, sidelined capital could rush in, driving prices toward the $60 to $70 range in the near term, with the longer-term potential still much higher. Now, we present the clips from MichaelOliver's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
We know the supply-demand in silver for several years now, at least, has been tight. There's not excess production in relation to demand. And in fact, there's a whole new demand quadrant out there, the solar panels. And China's a big consumer of silver for the purpose of, they're like 80% of the world's solar panel production. That's one factor. But the other factor is this: just over time, monetary metals advance, not because of this war or that war. In fact, wars are usually a negative for them. It's due to underlying monetary degradation that is ongoing. So if you look at an M2 chart, money supply chart on the Federal Reserve site in St. Louis, you see this upward curving ballistic chart of the growth of money in the beginning in 1960, and then get the number for 1970 and do the math, 70 to 80, 80 to 90. You'll see the annual growth is, like 80, 90% every decade. 80 to 90%, meaning good percent every year. We're increasing that now. In fact, that chart is starting to go parabolic a bit. But over time, gold will match the ongoing degradation in a fiat currency. And obviously, when you increase the supply, it degrades its buying power. So that's why a loaf of bread when I was a kid was 20 cents and now it's not. Okay. Degradation of money, or why, when your granddad built a house, it was $4,000, now it's $450,000, same house. Ongoing degradation in money. And gold, if you plot over history, will keep up with that degradation in the fiat currencies. Silver is a traveling partner with gold. Yes, it underperforms, and then it suddenly, as you pointed out, like in 1998 to 2000, went ballistic on the upside. 1979 to 80 went ballistic on the upside. And then again from that About 2010 to 11, it went ballistic very quickly. In other words, what it took several years to do, it suddenly did in 4 or 5 months. But if you go back and assess where silver might be now, given the ongoing degradation decade by decade in the money supply, why should silver be lower than it was in 1980 or 2011? What doesn't make any sense? Gold is well above those levels. In fact, even copper is above its 2011 highs. Copper, okay. Why shouldn't silver be? I think it's just a grand mistake. Markets make mistakes. They remain underpriced for too long because of sentiment, etc. And then when they say, oops, I made a mistake, you get ballistic moves. And I think that's what we're seeing. We see it technically happening. And when I say 60 to 70, all I mean is we're going to just blow out those silly old highs, because they really are silly. Because given the monetary degradation since 2011 or 1980, silver would probably be $200 to match the real buying power of silver at those peaks. And ultimately, that's probably where it's going. I'm just talking about this surge. And I think that because if folks are so silly focused on 50 and 50, that a lot of people are going to think that's technically important to take it out. And they're finally going to wake up when silver does blow through that silly price level. And then you're going to have the public say, well, golly, all-time new highs in silver. Why wasn't I there? In fact, in real dollar terms, it's still undervalued taking out those highs. But I think that you're going to gush through that, run all the stops, so to speak, suck in new money that hasn't been in at the appropriate places, and won't level off and pause until you get up to about 60 or 70. We've got a few technical reasons for that. But that's not the top. I'm just talking about this surge, meaning between now and year end. We're arguing this particular wake-up phase in silver, where it finally does what copper's already done, take out the 2011 high, what gold has amply done, taking out its prior major peaks. Silver's going to rush those old highs. It's been a major technical and fundamental mistake for it not to have already done so, along with copper, for example, and gold. And on a monetary basis, in real dollar terms, if you undegrade the price of silver and put it in line with where the degraded dollar really is now versus where it was in 1980 or 2011 peak in silver would probably be $200 an ounce just to match those highs in real spendable dollar terms. In other words, to compensate for the monetary degradation. But we're just talking technically about this particular surge because we think those two highs, we call them idiot highs. Frankly, because they are stupid, because they're so many decades ago that they're next to meaningless in real value terms. But everybody is aware of the two peaks at 50. And so when every investor out there is aware of it, that's the point where they'll finally wake up and get a smack in the face and say, gee, why wasn't I already there? And that's when they'll get interested, and you'll no doubt get some gushing buying on the other side of 50. You're not going up to 50 and stop again, okay? You'll blow it out. And when you do, you're going to get a gush of buying, and it'll probably at least take you another $20 or so. And again, there's minor technical reasons for that. It's not a long-term top. We think silver ultimately may go to like $200 an ounce over the following year. There are other factors in play here that will facilitate or stimulate that further move in gold and silver. And that is the breakdown in the stock market, which always then is followed by massive breakdown in the data points. Employment numbers go bad really, really fast. Factory output, all the numbers that the Fed likes to look at and use as their academic excuse, they'll have. And in which case, and plus we have a president who wants to print. Okay. So, he wants a Fed chair that will do the same. So we know that's going to happen. In fact, it's going to happen before Powell leaves because he'll have enough evidence, and already he's got enough objections from members of the Fed board to have to pay attention. It was 2, now it's 3 and 4 saying, yeah, we need to cut. Okay. So it's going to happen. And that means that the Fed, again, will put their pedal further on the floor, put their foot onto the pedal, and you'll have monetary excess in all kinds of different ways. You'll see it in the M2, you'll see it in Fed on the rate cuts, and also see in their buying, their balance sheet, because there will be emergencies out there. And we're looking at certain areas in the stock market that most people aren't. Most people look at NVIDIA and Microsoft, and I pay real close attention to them right now, especially where they close this week out. We've got some numbers that are being, especially on Microsoft, that are being threatened right now. We get a couple days left in the week, but you break them, all of a sudden, one of the two remaining leaders of the Mag 7 will start to go down sharply, and that's going to surprise people and probably help take the market down. Because in that last break we just had in the S&P a few weeks ago, Microsoft and NVIDIA did not break the same metrics that we saw broken in the S&P and NASDAQ. Now, if they're ready to break down, then all of a sudden, your leadership, even in the Mag 7, is no longer 7. You're now down to 2 or 3. That's it. The other 4 are not leaders. You compare it to prices they were at the last year, and they're so-so. Anyway, once that happens, that's when the central bank goes full throttle again. And especially if we know Trump's going to pick somebody who's going to go full throttle. And therefore, book it. And the problem with that is, if you go back historically and look at the 2000 to 2002 bear, or the 2007 to 9, when the Fed went full throttle, it did not help the stock market. They cut rates all the way down, and the stock market imploded anyway.
Broader market shifts are reinforcing silver's technical setup. While the metal has been consolidating near $39, it has shown resilience, with no sustained sell-offs. This strength contrasts sharply with the increasingly fragile stock market, where leadership has narrowed to just a handful of mega-cap names. Historically, when equity markets break down, capital flows into monetary metals and mining stocks, and early signs of that rotation are already visible. Silver miners, along with gold miners, have started outperforming the S&P 500 for the first time in a decade. Even on days when gold dips, miners are holding firm or even rising. This suggests that institutional money is repositioning, sensing weakness in equities, and seeking value in precious metals. Technically, both the gold and silver mining ETFs, like GDX and SIL, have broken out of massive multi-year bases, patterns that often precede large, sustained rallies. In SIL's case, the base spans nearly a decade, and its recent breakout signals an upside move toward previous highs. One telling example is Newmont, a major mining stock, which has surged over 80% this year, despite gold's sideways trading. This kind of price action indicates deep-pocketed accumulation, likely in anticipation of higher metals prices ahead. With the stock market showing signs of forming a dangerous broadening top pattern and treasury bonds underperforming, precious metals remain one of the few areas demonstrating persistent strength. Once equities stumble, the inflow of capital into silver and its miners could accelerate sharply. Let's get back to the interview.
Yeah, it's congested for the last 4 weeks, let's say. 39 has been a level that the ever bears keep selling. Probably because it's in front of a big round number called 40, so, hey, let's risk a dime, and so far they're getting a lot of selling done, but not much price sustainability on the downside. It has spiked down to 37.50. Right now, the SEP silver's trading 38.50, and that was earlier this week or last week at the 37.50. So there's no real sell-off in silver, just a pause, okay? The big issue, I think, is what the stock market asset flows. Now, right now, the stock market is so frothy that I can't believe it. It is really frothy. And in fact, a lot of fundamental analysts out there, and I don't read this stuff in depth, but I know where they're coming from. Leadership is gone. In other words, you're down to very narrow leadership within the market that has driven it to a marginal new high. I say marginal, I mean, we're like 4 or 5% above the highs we saw late in 2024, early 2025. Most of the buying was in the just getting back there. Okay. Now, if you look at gold, a lot of people assume that if the stock market goes down and you guys are right, it's going to be a bear market, then gold's going to go down too, right? Well, historically, that's not true. I'm going to bet you that when the S&P does start down again and prove, even to the price chart guys, that the recent breakout above the early year highs was false, meaning unsustainable. It was just another new high that didn't go anywhere. gold will be advancing through the 3,500 and all the way up. In fact, if you look within the gold complex, the monetary metal complex, and look at silver since mid-April, it's gone up. The gold miners, silver miners have gone up, even though gold has just held steady. So this fits with another scenario we have, and that is the asset flows in that area now favor the miners in silver. And therefore, we do think silver will see that zone this year, 60 to 70. Actually, from an investment point of view, if you go back, 4, 5, 6 years, you'll find that silver's gained just about as much as gold. It's been more irregular and more. And there was a period there from those mid-2020 price surge where, gold got up over 2,000 and silver got up to 30 area. That gold went sideways during that next several years, 2021, 22, 23, and into early 24. And silver and the gold and silver miners had a staircasing pullback, overlapping, go down, go up, but net on balance, a pullback. So they underperformed. Technically speaking, when we assess that spread relationship between silver and gold and the miners and gold, they've broken out. In other words, they've said to us, that relative performance, underperformance trend is over. They're now outperforming again. And sure enough, look what's happened, over the last couple of months, especially since April. Silver's gone up from, a high in, you go back a year ago, and in May 24, we had a surge high at 32.70. And then since gold's gone sideways since April, silver's gained, about 10, 15%. And the gold miners have really asserted themselves in a way that surprises most people. Because usually it used to be, if gold has a down day, the miners get beat up pretty good. Now gold could have a down day and they're up. It's surprising to most, not to us. I think that's an indication, especially in the mining sector, that there is money beginning to flow out of the stock market that is it is doubtful money, meaning they doubt the sustainability of what they're seeing on the tape. And therefore, they're moving into other assets. And they finally realize that actually the gold miners, they're at a better level now than they've been for 10 years versus the S&P. They've been, in other words, 10 years ago, they're beating the S&P. If you just bought and hold the gold miners. Nobody knows that. They don't mention that on Fox Business or CNBC about how gold, silver, and the miners are outperforming the S&P 500. And not just for this last year or, several months, but for a protracted period of time. I think that'll continue. And especially when the stock market wobbles back. Now, we come up with numbers every week that if you crack them, you're likely to start back down. If we fall back below the price highs we saw early this year, which is like, 2,200 area in the S&P and so forth and so on, you can look at your charts. Then the price guys are going to start to say, well, golly, gee, that's, and somebody's going to mention that classic chart pattern to them, the broadening top. And I think that's what we're building in the stock market. And it's a very dangerous pattern because when it's over, it's over. And momentum argues to us by price making new high. Momentum is clearly not. Momentum is, in fact, broken trend. Don't trust the new highs. Okay, if that's the case, then money is going to really start to flow out of the stock market at some point, and I think soon, probably. And where's it going to go? Well, if you do all the performance graphs you want to of this asset category and that, you'll see T-bonds haven't been doing well. They're usually an alternative to the stock market. Not much is doing well, except gold persistently has been doing well. And more money will flow. Look at a chart of Newmont, for example. Pardon me for getting long-winded here. Newmont has both outperformed vastly and underperformed vastly gold price over the years and the mining sector. It's the big blue chip. It's the one that if you're a major asset manager and you're going to buy into the gold stock arena, you're probably going to include Newmont. Why? Because it's the big blue chip. You're not going to go out and buy juniors or something. It has exploded this year. It's up like 85%. What's the S&P up? 10, 15 from the year with the close of last year. So there's no comparison. Money is flowing into that for some reason. And a lot of that explosion in Newmont has occurred while gold's been going sideways. So think about that. Somebody's buying the gold miners. Why? It's not because they're all frothy about gold over the last 4 months. It's because they're moving money somewhere to somewhere. I think as you break the stock market, that money flow will become massive. GDX, for example, or SIL, the silver miner ETF, you go back and look at the 2011 high, look what happened to 2015 collapse, just like gold. Then they built this big, huge, I'm just talking price now. Momentum has already been ahead of this game. Price has built this massive, wide base. For instance, SIL, the silver miner ETF, it's like 10 years wide, of up, down in the same range. We've blown through the top of that. We just broke out over the top of that range. And even just the dimension of the price base, forget our momentum work, which has said this all along, the dimension of the price base added to itself, in other words, a swing move, says you're going to go to the old highs again quickly. Whereas GDX is going well up into the 60, 70 zone. It's now in mid 50s, upper 50s, excuse me. And SIL is going to explode as well. So, the miners are really technically set, both momentum and now with price action, to launch. And it's fresh when you look at the price charts of the miners, looking at the big picture again, that basing pattern. It's only just in the last month or two that they've broken through the top of the base. So people that argue, oh, they got to correct, heck, they just broke out of your price base.
Silver's path forward looks increasingly clear. With supply constraints, surging industrial demand, and a monetary backdrop that erodes the value of cash, the stage is set for a breakout. The metal has already begun to outperform gold in recent months, and miners are showing the kind of strength that historically precedes major rallies. Breaking above the old $50 highs will be a psychological and technical event, likely drawing in fresh capital from investors who have ignored silver for years. In real purchasing power, that level is still far below silver's actual value, leaving substantial room for further gains. The next phase could see silver surge towards $60 to $70 by year-end, with longer-term potential extending to $200 in today's dollars. For investors, this is a moment to watch closely. If you found this analysis valuable, be sure to like, subscribe, and share your thoughts in the comments below.